Welcome to Deloitte's Dbriefs Tax Webcast series in Asia Pacific. Our webcast today is from our Geography Updates series and is entitled China VAT Legislation Update. My name is Candy Tang, and I'm a tax partner based in Deloitte, China. I have the pleasure of hosting today's webcast. I have two speakers with me today, Li Qun and Janet Zhang. Both Li Qun and Janet are partners in Deloitte, China. You may access our bios on the left side of the screen. Before I introduce today's agenda, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit it at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to Download and Links box. On the other hand, mobile device users can view the slides and answer the survey on the screen. Thirdly, if you require attendance record of this event, you will receive an automated email with CPE certificate after watching for 15 minutes. First of all, let's take a quick look at the topics we'll discuss today, which is about the newly published implementation regulations of the China VAT law. As you may recall, we hosted a similar webcast in this forum in September last year to introduce a draft version of the implementation regulations. Now, the final rules were published on December 30th, 2025, which contains some notable changes compared to the draft regulations. So in this webcast, we will share with you the highlights on the key points in the new regulations and our suggestions on the way forward to enable a successful transition to accommodate the new regulations. We are also pleased to address questions in the Q&A session. Now let's move on to take a quick look at the recent developments of the China's VAT legislation. In this slide, we have drawn a roadmap of the development of the China VAT legislation. In summary, China introduced the VAT system back in 1994 and conducted several rounds of reforms of the VAT system. Notably, China launched the VAT reform to convert the service sectors, which were taxed under another turnover tax called business tax, to VAT during 2012 to 2016, so that all businesses in China are subject to VAT after that reform. Then, since 2017, the China government continued to reform VAT in China by cutting down the VAT rates. For example, the highest rate of 17% was reduced to 13% on the supply of tangible goods and allowed taxpayers to apply for a cash refund of unutilized input VAT, which brings a cash flow benefit to the taxpayers. In 2019, the Chinese government started the VAT legislation process and finally released the formal VAT law on December 25th, 2024, which was the Christmas Day. To facilitate the enforcement of the new law, the Chinese tax authorities released implementation regulations to provide more clarities and guidance. Both the new VAT law and its implementation regulations took effect on January 1st, 2026. If we look at the implementation regulations itself, it contains 6 chapters and 54 articles to provide supplements and detailed regulations to the law. The implementation regulations also introduce some critical clarifications and changes, such as the definition of the place of supply rules for services consumed in China, withholding agents, deemed taxable supply, input VAT recoverability for assets which are used for both VAT taxable and VAT exempt supplies, mixed sales, and the introduction of the general tax avoidance rules. All these changes are very important and shall be examined so as to assess the impacts on the businesses operating in China. Before we dive into the detailed changes, let's do the first polling question of the day. The question is, which of the following changes brought by the China VAT law and its implementation regulations most impact on your business and require priority response? And your options are: number one, increase the non-compliant cost and high audit risk resulting from the elevated legal effect from regulations to law. Number two, changes to definition rules for core business scenarios, such as mixed sales, deemed sales, and non-VAT taxable transactions, which directly affect business models and contract signing. Thirdly, clarification of tax collection methods, including the implementation of VAT credit refund system, tax liability timing, and tax filing deadlines. Next is the new invoice management rules, new deduction voucher requirements, and corresponding upgrades and transformation of enterprise financial systems. The last one is don't know or not applicable. You can select multiple choices based on your decision. While we are waiting for the results to come in, Liqun, may I ask a quick question?
Sure.
The VAT law retains the current VAT rates of 0%, 6%, 9%, and 13%, plus the levy rate of 3%. But the 5% seems gone. So some companies are asking whether the 5% reduced levy rate will continue to apply in the new law or completely gone.
Yes, the 5% levy rate was not mentioned in the VAT law or the implementation regulations. Only the 3% levy rate was provided, so it is generally understood that the 5% rate will be gone for good. By the end of last year, a policy regarding individuals selling real properties acquired for more than 2 years provided that the levy rate of 3% would replace the 5% rate from January 1st, 2026. This new policy also seemed to indicate that the 5% rate will be gone. But it is uncertain whether there will be any transitional policy to allow the 5% levy rate to apply in a transitional period in order to avoid abrupt changes to the tax burden of the impacted taxpayers.
Thanks, Liqun. Now we have the result of the polling. It seems that around half of the audience select changes to the definition rules for core business scenarios, because these core scenarios are really important, and the new changes of the regulations can have impacts on the businesses. And then I think we have around 40% of the audience selects number one, the increased non-compliance costs and higher audit risk resulting from the elevated legal effect from regulation to law. And also around 35% of the audience are focused on the new invoicing requirements and other supporting documentation requirements. I think this results fairly reflect what businesses are thinking about the new law's impact on their businesses operating in China. So with that, I will hand over to Liqun to introduce some of the highlights on the key points. Over to you, Liqun.
Okay, thank you, Candy. So let's start with the place of supply rules under the VAT law. If the place of supply is deemed to be within the territory of China, the relevant transaction is subject to Chinese VAT. The VAT law and its implementation regulations provide the following rules for determining the place of supply. For the sales of goods, the place of supply is in China if either the goods are located in China or their place of departure is situated in China. For the sale or lease of immovable property and the transfer of natural resource use rights, the place of supply is in China if the immovable property or the natural resources in question are located in China. For the sale of financial instruments, the place of supply is in China if the financial instrument is issued in China, or the seller is a Chinese entity or individual. This rule is different from the old regime under which the place of supply was considered to be in China if either the seller or the buyer was a Chinese party. In practice, transactions involving financial instruments may be very complex. Sometimes it is challenging to clearly identify the seller in such transactions. For example, some transactions may involve both parties making payments to each other, making it very difficult to tell who is the seller. For the sales of service or intangible assets, the place of supply is in China if the service or intangible asset is consumed in China, or the seller is a domestic party. Now let's move on to the next slide to take a closer look at the place of supply rule for services and intangible assets. In cases where the service or intangible asset is supplied by a foreign party, the implementation regulations further specify that the service or intangible asset is deemed to be consumed in China under the following two circumstances. Number one, the service or intangible asset is supplied to a domestic party, excluding services consumed on-site overseas. And the services or intangible asset is directly linked to goods, immovable property, or natural resources located in China. For the first circumstance, the above rules imply a potential expansion of the VAT scope. Unlike the previous rules, which excluded services or intangible assets wholly incurred overseas, for the VAT scope, the new implementation regulations included only services consumed on-site overseas. So how to define consumed on-site overseas is very important. An easy example is an employee of a Chinese entity traveling to overseas and consumes accommodation or catering services out of China. The accommodation and catering services are consumed on-site overseas, but other services may be more complicated. So we are expecting the authorities to provide further guidance in this regard. In the second circumstance, the key is how to determine whether a service is directly related to goods, real property, or natural resources in China. Please note that in the second circumstance, where the service recipient is, does not make a difference. For example, a foreign company A purchases products from a Chinese supplier, and company A engages a service provider, foreign company B, to perform testing on the products provided by the Chinese supplier. Although both the service provider and the service recipient are non-residents, since the testing service is directly related to goods in China, the service should be viewed as being consumed in China. In practice, there are more complicated cases which would require further clarifications on the concept of directly related to through official guidance. Next slide, please. Where a foreign taxpayer leases immovable property located in China to an individual, the implementation regulations allow the taxpayer to appoint a domestic agent to handle VAT filing and payment obligations in China. However, in cases where a foreign taxpayer supplies other services or intangible assets to individuals and thus becomes subject to Chinese VAT, the VAT law and its implementation regulations remain silent as to whether such taxpayer may similarly appoint a domestic agent to handle its VAT affairs. or whether the VAT must instead be withheld and remitted by the individual purchasers. Under the old rules, the Chinese purchaser should act as the withholding agent of the non-resident to handle VAT filing and payment obligations. In practice, the withholding mechanism does not work when the Chinese purchaser is an individual. For example, in e-commerce business, especially in B2C business, individuals as purchasers do not have the knowledge or the motivation to perform the withholding obligations. This issue is not addressed in the VAT law or the implementation rules. Next slide, please. Under the old VAT rules, there were a long list of transactions that are considered taxable under the deemed sales provisions. The VAT law shortened this list by removing some transactions that could be covered under normal taxable supplies. For example, providing products to a subsidiary as capital investment was removed from the deemed sales list. This does not mean that such a supply is no longer subject to VAT. Gratuitous services. However, uncertainty remains as to whether certain free-of-charge service arrangements might still be challenged by the tax authorities through the application of anti-avoidance rules to recharacterize such relevant transactions. Okay, I'll stop here and pass back to Candy.
Yeah, thanks, Li Qun. Sounds a lot of changes on the output side. I've noticed that there are lots of changes on the input side as well. So Janet, may I ask you to help share with the audience the major changes on the input side?
Sure. Thank you, Candy. The VAT law and its implementation regulation actually introduced several key changes to the rules regarding input VAT deduction. Firstly, a new provision explicitly disallowed the deduction of input VAT associated with non-taxable transactions, provided that the specific conditions are fulfilled. Such transactions are defined as non-deductible, non-taxable transactions. The previous rules did not clearly disallow the crediting of input VAT in relation to non-taxable transactions. Consequently, this updated provision may effectively narrow the scope of deductible input VAT. Two core conditions must be fulfilled for a transaction to be categorized as a non-deductible, non-taxable transaction. First, the transaction involves business activities that fall outside the scope stipulated in Article 3 to 5 of the VAT law, and the taxpayer obtain relevant economic benefits in either monetary or non-monetary form. Article 3 to 5 of the VAT law define the scope of taxable transactions and deemed sales. So essentially, the first condition includes three key elements. The transaction is neither a taxable sales or a deemed sales. It constitutes a business activity, and it generates economic benefits. The second condition for non-deductible, non-taxable transaction is the transaction does not fall within the items listed in the Article 6 of the VAT law. As indicated at the bottom left of this page, these items include receiving compensation for services rendered by an employee to their employer, obtaining governance fees and charges, receiving compensation for expropriation or requisition in accordance with the relevant laws, earning deposit interest. In practice, non-taxable transactions cover a broad range of categories. For example, non-taxable compensation or penalties and government subsidies may not constitute business activities and may not constitute non-deductible, non-taxable transactions. By contrast, offshore trade may be generally classified as a business activity, and the input VAT is not deductible. In addition, for certain non-taxable transactions, such as equity transfer and dividend, the deductibility of input VAT would depend on further clarification on the definition of business activities. Another controversial issue is the accurate allocation of input VAT to the non-deductible, non-taxable transactions. Given these unsolved issues, further regulatory guideline is expected to be issued to clarify the relevant details. Next slide. Beyond non-deductible input VAT on non-taxable transactions, another key change regarding input VAT is the introduction of a mandatory annual reconciliation requirement for non-deductible input VAT. The rule targets specific transactions where input VAT cannot be deducted, including those under the simplified taxation method, VAT-exempt transactions, non-deductible, non-taxable transactions. For such cases, the relevant input VAT must be transferred out and recognized as VAT costs. When input VAT cannot be clearly distinguished between deductible and non-deductible users, the non-deductible portion should be calculated monthly based on the proportion of non-deductible transaction sales to the total sales. The annual reconciliation requires recalculating the non-deductible input VAT using the full year's input VAT amount and annual sales proportion, which may lead to adjustment to the total non-deductible input VAT for the year. This is a significant shift from the previous rules, where annual reconciliation was optional and subject to local tax authorities' discretion, but now it has become a mandatory obligation for taxpayers. On one hand, this new requirement effectively prevents taxpayers from underreporting non-deductible input VAT by manipulating monthly input VAT records and sales recognition. On the other hand, it also increased taxpayers' compliance burden, as the need to strengthen year-round data management and accounting to meet the reconciliation requirements. Next slide, please. We will be talking about another critical change in input VAT policy, specifically for long-term assets. Under the previous rules, general VAT taxpayer could fully credit the VAT on long-term assets, including fixed assets, intangible assets, and real estate, regardless of their original value, even if these assets are used for both taxable transactions under the general taxation method and non-deductible transactions. This special treatment was designed to encourage investment in long-term assets. However, the new regulation introduced an allocation requirement for single long-term assets with an original value exceeding 5 million yuan. Taxpayer can still claim full input VAT credit when acquiring such assets, but they should conduct an annual adjustment, reversing the credit amount corresponding to the asset's usage in the non-deductible activities based on its depreciation or amortization schedule. To put this simple, the original tax treatment remains unchanged for long-term assets with an original value of less than 5 million yuan, full input VAT credit is still available without any allocation. For those exceeding 5 million, the input VAT attributable to non-deductible items is no longer creditable and must be transferred out as cost on an annual basis. This adjustment balances encouraging long-term asset investment and keeping the tax burden fair. On one hand, it retains preferential treatments for low-value long-term assets. On the other hand, it strengthens the supervision of high-value assets, preventing tax loopholes while aligning the overall trend of refined VAT administration. Next slide. Let's take a concrete example to make this clear. Company Z purchased two equipment A with an original value of 6 million and input tax 780,000, and equipment B valued at 3 million yuan and the input VAT amount to 390,000. Both equipment have a 10-year depreciation period, which are consistent for both accounting and tax purpose, and used for over this decade for both general taxation method items and VAT exempt items. In the first year, Company Z recorded total sales 10 million, of which 4 million came from the non-deductible items. Now let's compare the treatments under the previous regulations and the new regulations. First, under the previous rules for both equipment, the input VAT could be fully deducted upon purchase without any follow-up adjustment needed. Under the new regulations, the treatment is different. For equipment A, the full input VAT of 780,000 is still available upon purchase. However, it needs to conduct an annual adjustment based on the asset's usage across different activities. Taking the first year as an example, the input VAT to be reversed is 31,200, calculated as 780,000 divided by 10 years, multiplied by 40%. For equipment B, the treatment remains the same as the previous VAT rules. That means full deduction upon purchase with no annual adjustment. From this example, we can clearly see that for high-value long-term assets over 5 million yuan used for mixed purposes, the input VAT can no longer be fully deducted, which will increase the enterprise VAT cost. Therefore, for enterprise planning significant long-term asset purchase, management must pay close attention to this new policy and may explore ways to mitigate the potential tax exposure. Next slide. Another key point regarding input VAT is on interest expenses. Although the VAT law itself does not clearly list loan interest input VAT as non-creditable, the implementation regulation clearly disallowed the deduction of input VAT incurred from loan services, as well as other costs directly associated with loan arrangements, such as investment advisory fees and financing consultancy fees. A notable change here is that the regulations add a temporary implication to this non-deductible rule and require the Finance and Taxation Authority under the State Council to timely study and evaluate the implementation effectiveness of this policy. This signals that the current restriction on deducting input VAT for loan interest and related expenses is not permanent. The non-deductibility of input VAT on interest expenses to a certain extent breaks the VAT deduction chain, increase the financing costs of enterprises. The introduction of the evaluation mechanism leaves room for future policy optimization, paving the way for potential adjustment to the deduction scope when conditions are ripe. Now I pass back to Candy to continue.
Thanks, Janet and Li Chun, for your sharing. It seems that these changes are very critical and may pose additional requirements for our taxpayers to change their current processes, controls, or even systems to accommodate the new requirements. That brings us to the second polling question of the day. The question is, how would the new regulations on non-deductible input VAT for non-taxable transactions impact your company? You have multiple choices to consider. The options are: number one, higher tax burden or costs; number two, more complex accounting; number three, impaired cash flow; number four, tax compliance risks; number five, minimum or no impact; and the last one is under evaluation. You may choose the option under your own situation. So while we are waiting for the results to come in, there is a question from the audience. The question is, we are an investment company, mainly engaged in investment activities in China and earning dividend back from the investment. Would the dividend income be considered as VAT non-taxable? Would the input VAT be creditable or not? So Janet, would you like to take that question, please?
Yes, happy to cover this question. Dividend income is not subject to VAT. In general, for an investment company, making investment and earning dividend may be regarded as business activities, as this is the main business of the company. As a result, the corresponding input VAT may not be creditable. Please keep an eye on the upcoming supplemental circulars and confirm this. Thank you, Candy.
Sure. Yeah, sure. Thank you, Janet. I think we have the result now. So it seems that over 50% of the audience select higher tax burden or cost or more complex accounting, whereby nearly half of the audience select the tax compliance risk, and then followed by impaired cash flow impact. So it seems that this is still a question that draws lots of attention from the audience. And then I would like to pass over to Li Chun and Janet again to share with us some other main impacts or changes of the regulations. Li Chun, would you please start first?
Thank you, Candy. So let's take a look at the question of transfer of going concern. In many countries' VAT rules, transfer of going concern is not subject to VAT. We have similar rules in China. Under the old VAT rules, in the process of asset restructuring, when a taxpayer transfers all or part of intangible assets, along with the associated creditors' rights, liabilities, and workforce, altogether to other parties, the transfer of goods, immovable properties, and land use rights involved is not subject to VAT. Neither the VAT law nor the draft regulations clarify whether the transfer of business or part of the business as a going concern would remain non-VATable. Furthermore, as Janet mentioned just now in the input VAT part, the VAT law and the implementation regulations provide no guidance on how to determine the input VAT attributable to such a transfer, if the business transfer is deemed to be non-VATable. So we are expecting that these matters may be addressed in the subsequent regulations to be issued by the authorities. Next slide, please. The implementation regulations introduced a new provision stipulating that when an individual engages in qualifying taxable transactions, a domestic entity paying the consideration must serve as the VAT withholding agent. This change could have significant implications for businesses that routinely procure taxable supplies from a large number of individuals. These businesses should closely monitor the application of the rules and any related guidance expected to be issued in the future. For example, pharmaceutical companies hold an event and invite doctors and experts as guest speakers, or companies hire retired senior management as advisors and pay them service fees. Under this new rule, the companies who make payments to these individuals shall act as the VAT withholding agent to help withhold and settle the VAT liabilities to the tax authorities. This is a new obligation to the companies, but this may help the companies solve the corporate income tax deduction issue. In practice, we have seen some tax audit cases where the tax authorities challenge on the corporate income tax deduction of the expenses paid to individuals due to the lack of VAT invoices. With the companies acting as the VAT withholding agents, the companies may be able to get VAT invoices to support their corporate income tax deduction. Let's move on to the next slide. Under the Chinese VAT rules, most exports of goods are exempted from VAT or qualify for zero rating. The input VAT for zero-rated exports may be refunded. The implementation regulations stipulate that exporters would be required to file for a VAT exemption or refund claim within a prescribed time frame. Failure to do so would result in the exports being treated as domestic taxable supplies. This is an important change since no such timeline exists under the previous rules. Taxpayers should review their VAT filing timeline to make sure that proper VAT exemption or zero rating treatment has been secured. Unlike the draft implementation regulations, which provided a time frame of 36 months after the date of export, the final regulations do not specify a specific filing deadline, which is expected to be clarified in the subsequent supporting guidance to be issued. Okay, now I pass on to Janet to continue.
Thanks, Li Qun. Another critical change under the implementation regulation of the VAT law is on mixed sales. A mixed sales is formally defined as a single VAT transaction comprising two or more components, which would be subject to different VAT rates if supplied separately. A typical illustration is the sales of air conditioners to consumers, coupled with the provision of installation services. Although air conditioner sales are subject to VAT at 13% rate and installation services to a 9% rate, the total sales revenue is taxed at 13%. This is because such transaction is deemed a mixed sales for VAT purpose. A comparison between the previous rules and the new regulation highlight two major differences. First, regarding the scope of mixed sales, the previous rules required the involvement of both goods and services. The new regulation, however, emphasized the involvement of two or more different applicable tax rates or levy rates without requiring the transaction to involve both goods and services. In other words, mixed sales may now include combination of multiple services where the respective services are subject to different VAT rates. Second, concerning the determination of the applicable VAT rate, under the previous rules, the rate applicable to mixed sales is determined based on the taxpayer's principal business. The new regulations, by contrast, change to the primary activity of the specific mixed sales transaction. This may be different from the taxpayer's overall principal business. In the next slide, we will be discussing how to determine whether a transaction constitutes a mixed sales and how to identify the primary activity of such a transaction. Next slide. According to the implementation regulation of the VAT law, a taxable transaction shall be treated as mixed sales only when both of the following conditions are satisfied. The taxable transaction involves two or more activities subject to different tax rates. This is the second one is there is a clear principal auxiliary relationship between these activities. Specifically, the principal activity plays a dominant role and reflects the essence and purpose of the entire transaction, while the auxiliary activity serves as a necessary supplement to the principal activity, and its occurrence is dependent on the principal activity. If these two conditions are met, the entire transaction should be subject to the VAT rate applicable to the primary activity. In contrast, if either of these two conditions is not met, the respective supplies should be accounted for separately and subject to VAT at their respective VAT rates. While this provision further clarifies the rules for mixed sales, it's still expected that it will remain one of the most controversial areas in practical VAT administration. It suggests to communicate with the tax authority when the case is complex and hard to assess the tax position. The taxpayers can also consider seeking advance ruling from tax authorities if the scenarios are complex. Next slide. Let's move on to another important rule introduced in the new regulation, which aim to strengthen tax supervision. Drawing on the approach adopted in income tax laws, the VAT implementation regulation also introduced a general anti-avoidance rule. This provision empowers tax authorities to challenge transactions arrangements that lack a valid commercial purpose. Specifically, if a taxpayer conducts transactions without reasonable commercial purpose, resulting in reduced, exempt, or deferred VAT payment, or increased or accelerated VAT refunds, tax authorities have the right to make adjustment using reasonable methods. For example, Company A is engaged in both air conditioner sales and installation services. It plans to restructure its business in 2026, transferring all installation services to a separate entity, Company B. After this restructuring, the combined VAT payable of the two companies is expected to decrease. In such cases, tax authorities may challenge this arrangement by applying the general anti-avoidance rule. This means that taxpayers should proactively evaluate potential tax risks arising from business restructuring or tax planning arrangements, and think about how to effectively demonstrate is driven by bona fide commercial reasons rather than solely for tax avoidance purposes. This puts higher requirements on enterprises' tax risk management and documentation of business purpose. I hand over to Candy to continue.
Thank you, Li Jun and Janet, for the sharing. That brings us to the last polling question of today. The question is, considering the potential impact of the VAT law and the implementation regulations on your business, what actions are you considering now? And you have multiple options to select again. So number one is to perform an assessment of the financial impact. Number two is to review contracts and business processes and consider changes. Number three is to seek clarification from the tax authorities and advisors. Number four is to adopt the automation and digital tools to enhance tax compliance. And the last one is none, no option to be taken. So you may select the options based on your situation. While we are waiting for the results to come in, there is a question from the audience. The question is, in your view, will the VAT zero rating or exemption policies likely to be extended? If yes, will there be any changes, say, on the scope, eligibility criteria, or application requirements? So Li Qun, would you please take that question?
Sure, Candy. Yeah, I would expect the scope of services that can be zero-rated or exempted to generally remain the same. But I hope there could be more clarifications regarding the eligibility criteria for zero rating or exemption. Since the old rules provide little guidance in terms of the criteria fully consumed out of China, in practice, we have seen different interpretations and practices with different tax authorities. For example, how to determine whether the services are related to goods in China. So more clarifications in this regard will be welcomed by the taxpayers.
Yeah, thank you, Li Qun. I think we have the result now. So it seems 1/3 of the audience select to perform an assessment on the financial impact, and another 1/3 of the audience select to seek clarifications on the new rules with the tax authorities and advisors. I think this basically reflects how our companies are looking on the new rules on their the impact on their business. So let's move on. That's all for what we have in terms of the key changes of the new VAT law and its implementation regulations. So it seems lots of changes and issues to remain to be clarified by the authorities. So please stay tuned. The China VAT legislation is not finished, but still ongoing. There will be multiple circulars to be released by the authorities to provide more guidance and clarifications on certain issues which we discussed just now. So on this diagram, as you can see, although the rules have been, the law itself and the implementation regulations already took effect from Jan 1st this year, but as we discussed, there will be related circulars to be issued very soon to facilitate the first VAT filing, which is due by middle next month. So from taxpayers' perspective, we actually have some recommendations for you to consider during this interim period. First of all, since the VAT law and its implementation regulations have already taken effect from Jan 1st this year, it is recommended to closely monitor the development of the new regulations and then assess the impact on your business from both finance, tax, and also business. So sorry, I have some connection issue and just come back. So on the implementation side, we have some recommendations for our audience to consider. First of all, since the VAT law and its implementation regulations have already taken effect from Jan 1st this year, it is recommended to closely monitor the development of the new regulations and then assess impact on your business from both finance, tax, and also business perspectives. And then businesses can implement a new process, controls, and systems, and also conduct periodic reviews to ensure ongoing compliance. When the authorities issue more detailed regulations or guidance, businesses shall pay attention and closely monitor the development of the future regulations while evaluate the impact of the new regulations on your business. At the same time, proactively seek specific clarifications from the local tax authorities and make full preparation for the first VAT filing, which is due on February 24th, which is the next month. Last but not the least, following the very first VAT filing period, business should again closely monitor and assess the post-filing tax implications and make appropriate adjustments where necessary. Let's move on. So in our recent communications with the companies, while different companies may have different questions or concerns about the new changes, there are several key areas of common interest that companies are navigating. For example, how to determine whether a supply is a mixed taxable transaction or a concurrent sale, as the applicable VAT rate can be quite different. On input VAT side, how to determine a single long-term asset, which is mixed use for both VAT taxable supply and the VAT exempt supply. How to identify and determine the input VAT in relation to non-VAT taxable transactions, etc. Especially if the group has multiple entities and a different governance structure, like by BUs or by cost centers, how to identify such long-term asset and input VAT attribution may not be straightforward and need more guidance. From tax planning side, the excessive input VAT credit refund is one of the ideas to bring cash flow back cash benefit. While companies need to balance the compliance risks and admin burden to make the application versus the cash flow benefit. Export VAT refund remains a key area of focus for businesses, either for export of goods or services. Companies are interested in the supplementary regulations, which may provide more clarities and guidance on the continuation of the preferential tax policies and potential changes on the applicable scope, eligibility criteria, and application procedures and requirements, etc. Last but not the least, most companies plan to conduct internal trainings, not only for their finance or tax teams, but also for business people on the new changes, because VAT is a transactional tax and heavily connected to business transactions on a daily basis. How to ensure the business team understand the new requirements is also crucial to the tax compliance work. So in summary, with all these changes and the new requirements, we have set out some recommendations for you to consider in the next slide, please. First of all, the taxpayers are recommended to keep monitoring the development of the regulations and assess the overall impact to their businesses and the specific situations. For example, to assess the impact on the company's revenue, profitability, cash flow, and estimate changes in tax liability, etc. Based on the impact assessment, proactively develop and refine response strategy and optimize business processes, such as review business model for VAT compliance, with particular attention to contract terms, invoice management, and eligibility for tax incentives. Pay close attention to the compliance treatment of cross-period transactions before and after the enactment of the law, and guard against potential tax risks. Another recommendation is to strengthen internal tax controls. In response to the policy changes, the companies should optimize internal tax control processes and strengthen controls over key tax risk areas. Pay close attention on the quality of the tax-related data obtained from other departments and teams, and carry out adaptability enhancement of financial and tax systems. Last but not the least, leverage external expertise. For the complex and uncertain matters, companies are recommended to proactively seek clarifications from tax authorities and, where possible, engage external advisors to assist with interpretation, implementation, and change management. By developing a coordinated, forward-looking strategy now, companies can ensure seamless compliance and build long-term resilience under the new VAT regime. Now let's move on to the Q&A session. Let me take a look at how many questions we've got for this event. So we have several questions. The first question is just want to ask if intercompany recharge, like management fee or marketing service fee within China and the foreign enterprises of the group, any need to open VAT invoice or debit note is already okay. So Li Qun, would you please take that question?
Sure. So this intercompany service charge is a typical cross-border service. And for cross-border services provided by the Chinese entity to its overseas service recipient, there is no need to issue VAT invoice. A commercial invoice will be sufficient. And I would also like to mention that for certain services, there is a possibility for the services to be exempted from VAT. But services like marketing service, there is uncertainty because such services may be considered as related to goods in China and may not qualify for VAT exemption. And for completeness purpose, I would also like to say that you may need to consider avoiding the wording like management fee, because that may give rise to risk for corporate income tax deduction.
Yeah, thanks, Li. Thanks for the answer on the recommendation on the management fee, which is a sensitive word in China. And we have another question. Do you expect the list of financial services which are exempt from VAT and the previous MOF SAT Circular 36 published back in 2016 to be published in upcoming SAT notice or guidance note? If yes, when do you expect this to be published? So Janet, would you like to take that question, please?
Sure. We expected the list of financial services VAT exempted will be covered in the upcoming supplemental circular. And regarding the publishment schedule, is hard to predict at the moment, but it should be before the filing due date of for the January, that is February 24, 2026.
Okay, thank you.
Back to you.
Yeah. So I think we may need to be more patient about the new regulations. And then we have a question. My company is an investment trading entity in Singapore who hold a Q fee. Any VAT implications on trading of financial instruments in mainland China, like equity, bond, derivative, buy and sell, interest, and dividends? This is actually a good question because in the new VAT law, there are some changes, especially in the law itself. It clearly stated that the sales of financial products in China is subject to China VAT. And then it is further explained in the regulation that if the product, the financial instruments is issued in China or the seller is in China, then this falls under the China VAT scope. However, for a Q fee, there are some preferential treatment like the VAT exemption treatment on some bond interest or some kind of trading through the qualified channels. So some of these preferential treatment may be extended in the near future, whereby some are still to be clarified. So please look into the new regulations. And the next one is, are supporting circulars expected to be issued centrally or by provincial authorities when contents may vary by location? This is actually a typical question because many of my clients are asking whether you have a centralized VAT law nationwide or you have local laws published by the local jurisdiction. The answer is we only have the law and regulations published by the central government, which applied to all in China. Just the law itself may not be detailed enough. So the local authorities may have their interpretations, which may vary from place to place. So that's one when the new rule coming out. It is important to understand the discretion and interpretation from the local authorities. So I think we are up on the 1 hour for this session. So Li Chu and Janet, thank you. And special thanks for all of you who were able to join us today. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you join us late, please know that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon or help them visit the Dbriefs webcast. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out either to me or to our speakers, Li Chu and Janet. We'll be more than happy to talk to you. And please do not forget to tune in our next scheduled webcast from the Corporate Income Tax on 5th of February, titled OECD Side-by-Side Package and AP Perspective. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast today. Goodbye.